most significant mistake people make is allowing the cost basis of their investments to drive their market decisions. I can't tell you, at our office, I'm down here in Boca Raton, meeting a lot of, especially retired clients, holding on to dogs of the Dow, waiting to get the money back. Yeah. And I'm like, it's an awful position. Well, it will eventually come back. We don't want to have a tax implication. Or we deal with a lot of achiever clients in Fortune 500 companies that have a lot of their portfolio positioned in one asset. Sometimes their company's stock. We don't want to pay taxes. We don't want any tax implications, and forget about, you know, diversifying their portfolio.
Mm-hmm. Tail wagging the dog, huh?
That is how it works. It shouldn't work. Right.
Okay.
What about goal planning? How should financial planning be when you're developing your investment goals? How should those two fit together?
Right. Well, based upon planning boards and studying things about financial planning, investment planning works the thing as financial planning. And basically, when a client comes in and meets with us, we don't want you to just write us a check and, hey, let's invest your money. We need to understand, and the clients need to understand, what are their personal goals. A dollar is just a dollar. What do you want the dollar to do? Is it for your retirement? Is it for your son's education? Is it to buy long-term care for your parents? Once you identify what you want your money to do for you, then you need to carefully articulate some financial literacy for your clients so that they understand what risk tolerance and volatility means and liquidity is and the tax situations are to better meet their goals.
Mm-hmm. Mm-hmm. Sounds like a lot of what you're talking about is almost independent from what's happening in the market, and that you start with the investor first.
Actually, exactly. We start with the end in mind. We want to make sure that our clients feel protected and they understand, you know, what their goals are and help them to achieve them.
Mm-hmm. Mm-hmm. Wonderful.
So in summation, then, in the last minute or so that we have, tell us, you know, what's your advice?
Okay. In summation of today's discussion on investment planning, I always tell my clients, don't have myopia or nearsightedness. Don't disconnect your portfolio goals with your investment goals. Don't spend countless hours watching all these TV shows, you know, people yelling at you, buy this, sell that. The market's up, the market's down. The market's changing while people are sitting here trying to figure out what's going on 9 to 5. So the bottom line is that the book Millionaire Next Door says the average investor only spends 6 minutes a day checking their portfolio. They're not losing sleep. So it's important to understand how your personal goals work with your investment portfolio and plan accordingly and logically based upon what you want to happen for your family.
Great. John, good advice. Thanks for joining us. Hope you'll come back.
Right. Well, we appreciate, thank you for having me on today.
Yeah, absolutely.
You're welcome.
Great.
In the meantime, Michael, where there's wisdom,
there's wealth, Joyce.
We thank you and good night.
Good night.
To receive a copy of your favorite